Hello, welcome to Macro Money. This is Ilya Spivak, head of global macro for tastylive, and we are going to do something a little bit special. We have been talking quite a lot about what it is that the Fed might do, what it is that we might see in terms of credit market stress or recession or soft landing or not soft landing. And I thought we might pull back a little bit on a day like today where we did not have the kind of dramatic market moves that we would see on days when there's a big piece of scheduled event risk, like a Fed announcement or a piece of important economic data, or there's some sort of thematic thing that's a standout on a given day, and instead focus on relationships and look specifically, in this case, at the foreign exchange, the FX market, just because it really tends to be a very good reflection of macro dynamics. Because, of course, we are looking here at money itself. And so a lot of the specific kind of asset considerations that we might have when we look at stocks, when we look at commodities, that can have much more unique elements to them than necessarily just the macro narrative. Just think of the specifics of differentiating companies within a sector, let's say, one automaker to another, one telecom to another. You could have specifics there that are much less macro, much more idiosyncratic. Here, in the FX market, you can really get a good sense for how macro works. And so what we are going to do here is see if we can use what happened in the FX markets last year to really understand how the trading of macro relationships might actually work in practice. So first, we're going to look at what happened in FX markets last year, and if we can very kind of simply understand what it was that moved the major currencies and why it moved them. Then we are going to look at what it would mean once we kind of understand which groups these currencies fall into and why they behave the way that they do, or at least the way that they did last year. What becomes the difference tactically in trading within each group versus one group against the other, and where that can be a different approach with benefits and costs depending on the situation. And then looking at how that might apply to how we think about markets next year, and what are some of the themes that could go into a macro approach. And so we should walk away from this hopefully with at least a bit of a lens on how we might think about what happens in the coming year and how we might contextualize that in terms of assets and in terms of a macro type of a trading idea. So what we are going to look at here is a very, very simple framework. Generally speaking, currencies are yield-bearing assets. When you own a currency, you can lend it out and earn the interest rate on that currency, which generally is a function of where interest rates are set by that country or geography's central bank. And of course, if you are a borrower of that currency, that same lending rate is your cost to borrowing. So in a very simple currency framework, what tends to be the case is that where interest rates are going up, that tends to be attractive as a currency to own because it can generate that yield income. all else being equal, and we'll see what that caveat means in just a second. And those currencies where interest rates are not going up tend to be less attractive. Last year was a very good case in point at the extremes of currency performance. Notice, by the way, that although there is clustering around the mean here, the trend line running through the major currencies is shaped such that it points from the lower left to the upper right, which means the more that there was positive change in interest rates in a given economy, the higher its FX return tended to be, which is the vertical axis that you see here. So you can see at the extremes, weakest currency, strongest currency. The US dollar had by far the best performance last year, rising close to 10%. It also had by far the most interest rate hikes. In Japan, alternatively, easily the worst performance, down almost 8%, no rate hikes. Very straightforward. Let's stay at the extremes. Here you have the difference in what happened in relative European FX performance. Switzerland, you can see it's not very high on the interest rate hike scale, under 2%, but it did perform much better than other European economies that had many more rate hikes. Eurozone, Norway, Sweden, UK. We'll talk about the UK in just a moment. But why Eurozone, Norway, and Sweden? Well, we have the benefit of geopolitical uncertainty in Switzerland at a time when there is currently a war between Russia and Ukraine, in which a lot of the other European economies are intimately involved, one way or another. But there is much more exposure there. Switzerland, of course, is historically neutral, so that exposure lends a degree of haven appeal at a time of uncertainty. And of course, what the markets hate most of all isn't necessarily a bad outcome versus a good outcome. It's an uncertain outcome that's difficult to plan for versus a sense of forecastability, where portfolios can be set up for the high likelihood of X event or Y event or Z event, as long as that likelihood appears high and the level of conviction appears high, markets are generally okay and relatively stable, and investors are relatively comfortable. It's when things are uncertain that investors get leery. And so Switzerland, although it seems to have less of an appeal on the yield front, has this extra benefit. The flip side of that is the UK. You can see many more rate hikes than other European economies, but at the same time, likewise, a political headwind. We, of course, surely recall the many headlines around political uncertainty in the UK last year, lots of churn in the Prime Minister's post, lots of uncertainty around how that government is going to look. And so, not surprisingly, the UK and the British pound a bit unloved here as relative to other European currencies. So again, extremes. Here we have rate extremes. Here we have political / geopolitical extremes explaining performance. And again, very simplistic framework here. Now we get into the meat. Take a look at the Eurozone versus Norway versus Sweden. Very comparable on the rate hike scale give or take between 2 and 3%. Let's call it an average of 2.5 or so. So why is the Eurozone performing better than Norway and Sweden? Well, Norway and Sweden are economies that are what we'll call here, this is a label that we've made up for this conversation, vendor markets. These are markets that depend on Eurozone demand for exports. Now, of course, the Eurozone is not the only market for Norway and Sweden, but of course, the proximity means that it is also the chief market, the largest market. What tends to happen in the kind of environment that we saw last year, where a rapid rise in global interest rates cools risk appetite market-wide. Of course, we saw stock markets fell last year in general. What tends to happen in that kind of environment is you get a move away from relative risk and toward relative safety. That is a move characterizing less demand, less appetite for risk in that end market. So capital flows from these vendor markets that depend on the demand back to end markets where the demand originates. And so you can see here that what you have is relative similarity as far as the amount of rate hikes, but the Eurozone outperforms because it has that relative haven quality of extra liquidity, of extra stability, of less risk as relative to, quote, vendor markets. You can see the same thing works when you compare Canada and the US. And of course, the US has particular outsized support because it also, because of the dollar's very unique quality as the most ubiquitous medium of exchange, according to the Bank of International Settlements, close to 80% of all monetary transactions are settled in the US dollar, which means it is uniquely liquid. But even here, you have this vendor market, end market relationship. Close to 80% of all Canadian exports are bound for the US. So there's a very similar relationship here, perhaps an even closer relationship in terms of volume and concentration than you have here. And of course, a comparable number of rate hikes, 4.5%, let's say an average of 4.25%. So, similar dynamic. The end market in a risk-off defensive kind of scenario sees capital inflows, the vendor market underperforms. Now, you can break this down and compare across thematic groups like this, end market versus vendor market, as here, or you can look within thematic groups and compare one end market to another in terms of relative performance. Again, very clear cut here. The US has more rate hikes. The US dollar performs better than the euro, holding constant that both of these markets benefit from capital flows out of quote unquote vendor economies. You can also compare the vendor economies and see interest rate differentiation. So whereas both see outflows at times of risk aversion, you can see rate hikes are higher in Canada, Australia, and New Zealand. There's more of them than in Norway and Sweden. And so those markets outperform. Those currencies outperform. Now, this particular part of the equation, and I put this slide last in this kind of group comparison for a reason, because here we can begin to have a conversation about 2023, where what we're looking at is a situation where we've had a lot of rate hikes, we've had a slowdown in global demand in response to those rate hikes, looking at leading economic indicators like, for example, the purchasing managers indices that S&P Global produces that are essentially a more real-time GDP approximation than GDP numbers themselves, which are notoriously lagged and only usually come out once a quarter, but with some exceptions. We have here a in PMI numbers, a kind of monthly real-time approximation of where growth is going. And on those numbers, the global economy has been shrinking since August of last year. Because, of course, we've had these dramatic rate hikes, really cooling demand, slowing growth, and giving us the defensive kind of environment that we're talking about. As we go into next year, it looks like that sort of situation is starting to bring down inflation, starting to put the end of at least the Fed's leading rate hike cycle into view. It's at this point fairly well baked into the market that we're going to get an end of that rate hike cycle sometime mid this year. Then, of course, we remember that monetary policy works, and this is the cliche to end all cliches, with long and variable lags. So we still don't quite appreciate what the consequences of this tightening are going to be in terms of its overall negative impact. And so we have a running conversation in markets as to whether we're going to have a global recession, whether we're going to have a recession that's avoided in some areas as opposed to look more severe in others, what those dynamics might look like. Are we, as we did in 06, 07, in the run-up to the explosive market situation in 08, 09, are we going to have a rate hike cycle, in this case, a much more aggressive one than last time, trigger another market crisis? Last time, in 07, 08, with the great financial crisis, we had a period of low interest rates create malinvestment in the housing market, which turned out to have systemic risk for the overall credit space and gave us a credit crunch and subsequently a very painful recession and market collapse. Here, as we've talked about on this show before, we've had very long of a gap between easing and tightening. The longest, as a matter of fact, in sort of the modern financial markets 40-year, 50-year history, going back to the end of the gold standard in the 1970s and sort of this start of free-floating exchange rates. So lots of opportunity within that time with rates at zero for some kind of malinvestment to occur and for some kind of systemic risk to start to grow. So we don't know as yet, and markets are understandably jittery, and this shows up in sudden and elevated spikes in U.S. dollar funding costs and in credit costs in general in the past 6 months, 9 months or so. Markets are understandably jittery going into next year. That as all of this tightening is really absorbed, all of these rate hikes really begin to reflect in the real economy. Still unclear how bad of an impact they're going to have on growth, even as they're having a a cooling effect already, and it's also unclear whether they're going to tip off some kind of crisis. And we might have another kind of binary risk on, risk off market where capital starts to aggressively flow from these thematic groups at the vendor economy level, at the cyclical economy level, aggressively into haven currencies. And we start to see another broad-based liquidation across stocks, across commodities. And we see a tremendous amount of potential, understandably, for volatility. And you can see that show up in markets, where every time the Fed offers some sort of a guidance on where the rate hike cycle might end, or economic data hints at that, there's explosive volatility in markets. It is an active object of speculation. Anytime there is a bump in the night in the credit space, jitters in the market, aggressive volatility. So markets are clearly on edge. Now, one way to get away from these things and these kinds of binary volatility dynamics is to look within these thematic groups. And so to look for opportunities to trade not at the extremes, but within these groupings, and try to hold as much of this kind of instability and volatility constant. And then to compare, again, on an interest rate basis, where this becomes perhaps the easiest thing to do, rather than attempt to forecast where the Fed might end its rate hike cycle, how the markets might react, whether we can anticipate a credit crisis or not. And one way you might think about this, and we might consider this, is to look at those currencies that are going to be correlated to those things in the same way. And here's an example. This is the 13-week correlation. So 1 quarter's a quarterly kind of correlation between the Australian dollar, that's the 6A future here, and the Canadian dollar. So what you see here is that, barring, let's say, a handful of periods, this correlation tends to be near perfect. So very, very high correlation most of the time. Not surprising. You can see both Australia and Canada are in this vendor market group. And so they respond to these kinds of dynamics in a similar way. Now, you might look at this situation and say, okay, well, Canada is, if we look at what's currently baked into markets, no longer expected to raise rates in this coming year. Priced in expectations show the Bank of Canada having raised rates aggressively last year, has moved into wait-and-see mode. Australia is still looking to perhaps raise rates some more, and there's maybe another 75 to 100 basis points, depending on a given day, that markets expect they will see from the RBA this year. That, of course, is already baked in. That's what market expectations suggest. We can look at now themes and say, well, how likely is that sort of differentiation to be sustained? Markets are, of course, ever forward-looking. That which is already baked into markets isn't necessarily something with the most potential for continued follow-through. But in this case, we have an about face on COVID management in China, Australia's largest export market, and an attempt between Beijing and Canberra to normalize relations. After about a year and a half of a spat that had China, in effect, ban imports of coal from Australia, one of the top two exports, along with iron ore. At the same time, Canada and the US had the largest rate hike cycles of the G10 last year, and Canada's end demand market is the US. Those rate hikes, while they of course make the currency outperform as they're occurring and running into them starting, they are also the tightest grip on economic growth, the hardest squeeze. And so growth is perhaps some of the most constricted in Canada and the US, and scope for further tightening is perhaps least in Canada and the US, as relative to this more positive story for Australia, with China's moving away from zero COVID lockdowns, with a bit of normalization, at least an attempt at normalization of relations, and a friendlier trade relationship between Australia and China. And so with that in mind, you might say, okay, well, if we then you look at Australia versus Canada and say, we're likely to have more scope for rate hikes in one, Australia, versus the other, Canada. Meanwhile, their close correlation relative to each other on risk sentiment grounds, global growth up or down, global financial stability up or down, that allows us to filter some of these other more erratic, more speculative and extreme factors out and look at just the rates. And indeed, if we look at a pair sort of setup between 6A futures and 6C futures, this is a ratio with 6A on top, 6C on the bottom. So when the chart goes up, that's Australia doing better. When the chart goes up, that's Canada and its dollar doing better. You can see that from 2021 through to now, not surprisingly, given how many more rate hikes there were in Canada over this period relative to Australia, you can see the Canadian dollar is outperforming. So the chart is moving lower. More recently, you can see the ratio is attempting to break that move down and extend upward. So perhaps if we can get out of this range on the top side here, you can see that's 93-24 or so on the ratio, then perhaps we've entered a new phase where 6A will outperform. And of course, if we tumble back inside that range and that downward sloping band, that would tell us something else is going on, because as ever, markets are ever changing. But this is how you might think about using that sort of thematic lens to take a step back and say, well, I don't have to speculate on the Fed. I don't have to speculate on financial stability or instability, soft landing, not soft landing. All of that is too hard. Perhaps instead, we might pull back and say, what about looking at a trade within these thematic groups and use rates as a kind of textbook differentiator that holds a lot of these other more difficult factors constant.